Okay, imagine you find this really interesting real estate deal. It's already making money, but it also looks like it could grow a lot.
Right. And this one's set in, well, Puerto Rico, specifically Rincon.
Exactly, Rincon, the surf town, popular with expats, travelers.
Yeah.
It's always had that appeal, but now it seems like the real estate market there is really heating up.
It really is. And what's great is we're not just talking theory. We've got the inside track on a specific project happening right now in Rincon's Puntas neighborhood.
Ah, Pudas. That's a prime spot, isn't it? Lots of vacation places, those cool surf hotels, some amazing homes overlooking the water.
Definitely. You can feel the energy there. Plus, all the interest Puerto Rico is getting from the mainland these days.
Yeah. So the focus of our deep dive today is this property Steve and Aaron picked up. It's on a hill in Puntas, good access, but also lots of potential.
It already has units, rentable units, bringing in cash. But like you said, the potential is the big story here.
Right. This isn't just a quick flip. They've got this multi-phase plan. Value add strategy, is that the term?
It's the one, value add. Basically, they plan to boost the property's value and its income through smart improvements and new construction later on.
So it's strategic, not just patching things up.
Exactly. It's about building something more substantial, something with long-term value, using that initial cash flow as a base.
Okay, so for everyone listening, our mission here is to really unpack this deal. Look at the numbers, the potential returns, but also why this market? Why now? What makes it tick?
Sounds good. Where should we start? Phase one.
Yeah, let's dig into phase one, the beginning. Acquisition and launch. What kind of initial costs are we talking about?
Well, you've got the usual suspects, the down payment, obviously, then legal fees, title insurance, all that groundwork.
Standard stuff.
Standard stuff. But what stood out to me was their focus on the business side right away. It wasn't just buying the building.
Oh, interesting. Like what did...
Well, the sources mentioned setting up marketing right from the start. Branding, getting the word out, plus software operating systems for management.
Ah, okay. So they're thinking efficiency and scaling from day one, not just fixing leaky taps.
Precisely. It shows, well, a professional approach. And then still in phase one, they dive right into fixing up the existing units.
And not just a coat of paint, right? The details mentioned seem pretty substantial.
Oh, yeah. Refreshing interiors, totally new appliances, always a big plus, and redoing kitchens and baths. They specifically mention design-forward details.
That's key, isn't it? In a place like Rincon, with lots of rentals, standing out aesthetically, that's how you justify higher rates.
Absolutely. It's about creating that wow factor for guests, which leads to good reviews, repeat bookings. It all feeds into the revenue.
Makes sense. So after the interiors, they move outside, phase 1A.
Correct. Phase 1A focuses on the exterior, improving the guest experience and, crucially, how it looks online.
Okay, so things like
Fencing for privacy, planting, practical things too, like solar upgrades. That appeals to a certain type of traveler and helps with costs.
and Rincon being a surf town.
You guessed it. Surfboard racks, outdoor showers, essential stuff there, even storage sheds for guests. Little things that make a difference for that target group.
Yeah, shows they understand the market. Anything else in 1A?
Some important infrastructure work. Reworking the driveway and parking, always good for guests. Adding landscaping, water features for appeal, and critically, preparing the site for future building.
Laying the groundwork, literally, for the next step.
Exactly. Which takes us to phase 2. This is what the sources called the big unlock.
The big unlock. Okay, I'm intrigued. This is the new construction part.
That's right. Building 3 entirely new rental units designed for island efficiency, as they put it.
Island efficiency. What does that mean in practice? What features?
Each unit gets its own entrance, vital for privacy. A private deck, you need that in Puerto Rico. EC, of course. A kitchenette. And the look is described as clean, modern.
Sounds like what travelers want these days. Stylish, but functional. And when are these supposed to be ready?
The timeline suggests around month 24, 2 years in.
Okay. And that's the point where the financials really start to shift.
That's what the projections indicate, yes.
Yeah.
Those new units coming online are expected to significantly boost the overall returns. It's the major value creation step.
Got it. So a clear progression. Stabilize, enhance, then expand. Makes sense? But
Yeah.
why Puerto Rico? Why Rincon specifically for this? Let's zoom out a bit.
Good question. Because Puerto Rico, it's more than just beaches now, right? It's becoming a serious investment destination.
What's driving that shift?
Well, a few big things. You hear a lot about the Act 60 tax incentives. We don't need to get lost in the weeds, but basically they make certain investments very tax-friendly. That pulls in capital.
Okay, the tax angle is definitely a factor. What else?
Just the basic rental market dynamics, demand for Airbnbs, short-term rentals, it's really strong. Lots of people want that kind of travel experience.
And the supply side.
That's the other piece. There's a relative lack of high-quality rentals to meet that demand. So if you build something good, people will come.
Plus, you have more people actually moving there from the mainland, right? Looking for the weather, the culture.
Exactly. That influx puts pressure on housing and rentals, too. It all adds up.
So that's Puerto Rico overall. What about Rincon's specific appeal? Why not San Juan or somewhere else?
Rincon has its own strong points. It's got a steady tourism base, surfers, expats, general tourists. The economy feels pretty resilient there.
And the location itself.
It's kind of the sweet spot, far enough from San Juan to feel relaxed, less chaotic, but close enough to get supplies, find workers, you know.
Right. Not totally isolated.
Not at all. And a really important point the sources mention, the market there is already tight on supply, and zoning is getting stricter.
So it might be getting harder to build new stuff there in the future.
That's the implication. Getting in now with a solid plan like this could be advantageous if new supply becomes more restricted down the line. It potentially locks in value.
Okay, so strong demand, limited quality supply, favorable location, potentially tightening regulations. That paints a compelling picture for the market side.
Definitely sets the stage for why an investment like this could work.
Right. So let's get into the investment itself, the nuts and bolts. Total capital needed across all phases is $725,000.
$725,000, yeah. That's the total target raise.
And how does it work for investors? What do they get?
They're offering 50% of the total equity in the property to the investor pool. It's structured on a pro rata basis.
Pro rata, meaning your ownership percentage matches your investment percentage.
Exactly. The example given was if you invest $100,000, that's 13.79% of the investor group's share, which works out to 6.9% ownership of the whole property.
Okay, so you own a slice of the actual real estate, but it's not just equity, right? There's cash flow too.
Absolutely. Investors are projected to get cash flow from the rentals, and then there's the potential upside later, maybe a refinance once the value increases, or an eventual sale.
Let's talk numbers then. Before those new units are built, phase one, what are the projected returns looking like?
So during that initial period, the estimate for a $100K investor is annual cash flow around $5,171.
Okay, about 5% cash on cash, roughly.
Roughly, yeah.
Hmm.
And over 6 years, that adds up. The projection is a total return of about $75,843 on that 100K. That's what, 75.8% ROI, average annualized return of 12.6%.
That's pretty solid for the stabilization phase. But the real jump happens after phase two, when the new units are online.
That's the plan. The projections show a significant shift then.
What are the assumptions behind that, like nightly rates, occupancy?
Key assumptions are average rate of $220 a night per new unit, occupancy at 60%, which is about 219 nights a year,
Okay, and that translates to,
about $48,000 in gross revenue per new unit per year. Times 3 units, you're looking at over $144,000 in new gross revenue.
well, okay. But you have costs, obviously, management expenses.
Right. The model includes a 10% management fee and another 10% for general operating costs, internet, water, things like that.
So after those costs, what's the net income from just the new units?
The net operating income, or NOI, from those 3 new units alone is projected at over $115,000 a year.
And when you add that to the income for the original units?
The total property NOI is projected to jump past $190,000 annually.
Okay, big increase. And investors get 50% of that total NOI.
That's the structure. So their share of the income effectively doubles compared to phase 1.
So that $100 NK investor, their annual cash flow goes from about $5 to...
Around $13,140 per year, starting around year 3 when those units are stabilized.
That's a serious jump, over 13% cash on cash annually.
And it changes the long-term picture significantly.
What does the total 6-year return look like then, including this higher cash flow?
The updated projection for the $100K investor over 6 years is a total return of $121,205. That's over 121% ROI.
And the average annual return?
Pushes over 20%. So you can really see the impact of that phase 2 development. And the source stresses these numbers are tied to the actual budgeted plans.
Right, not just wishful thinking. It demonstrates that value add potential quite clearly.
Exactly. It shows how enhancing and expanding can, really move the needle.
Okay, so the deal structure looks interesting. The market context makes sense. But who's actually running this? Steve and Aaron. What's their background? Experience matters hugely in these things.
Absolutely critical. And from the sounds of it, they're not new to this game. They've got a history flipping homes, managing rentals.
Whereabouts?
In Maine and the Midwest, apparently. Built up vacation rental portfolios there, so experience in different markets, different property types.
Okay, that's good grounding. Anything else?
Yeah, it seems their experience is broader too, running resorts, advising other investors, building brands, and importantly, a track record of outperforming market averages with properties they've managed.
That suggests they know the operational side and the business strategy side.
It seems so. The source material really emphasized their pragmatic approach, focus on real things with real strategy in markets that make sense.
I like the sound of that. Grounded. No chasing crazy trends.
Exactly. Sounds like they focus on tangible assets, solid plans, and crucially, they're described as hands-on.
Meaning they understand the details.
Yeah, like layout, lighting, linens, even things like lock codes for check-in. The small stuff that actually makes a big difference to guest experience and ultimately reviews and revenue.
hmm That attention to detail often separates the okay rentals from the really successful ones.
Couldn't agree more. So you seem to have experienced operators, a clear plan, and a promising market.
Okay, let's try and wrap this up then. If someone's listening and thinking about this, what's the summary? The key takeaways of this specific opportunity?
Well, first, investors get 50% equity, real ownership. Second, it's already generating income from existing rentals, so there's immediate cash flow.
Right, not just waiting for construction.
Exactly. Third, there's that significant upside potential from building the new units, the value add piece. Fourth, the projections point towards a potential refinance or sale in maybe 5-6 years.
So multiple potential exit points or return accelerators.
And fundamentally, it's a chance to own property in a prime spot in Puerto Rico, get cash flow, and partner with an experienced team.
Owning a piece of Rincon. There's definitely an appeal there beyond just the spreadsheet numbers.
For sure. It's a tangible asset in a desirable location.
Okay, so as we finish this deep dive, it definitely leaves you thinking. Given the potential returns, the market dynamics in Puerto Rico we talked about, what are the really crucial things someone should weigh up if they're considering an investment like this?
Yeah, it's more than just the projected ROI, isn't it? You have to think about the operators, the market risks, the execution risks.
Exactly. Lots to consider. Hopefully this deep dive has given everyone a solid starting point to, think about those factors for themselves.
Yeah, a good foundation for further thought.